In October 2008, the equity markets were in turmoil. Following the collapse of Lehman Brothers, panic spread throughout the global financial system and the markets were tumbling down. In the middle of this chaos, for one day, on the 28th of October, Volkswagen's stock rose by more than 200%, making it the most valuable company in the world. Wondering how that happened? This rocketing rise of Volkswagen's shares was driven by a stock market phenomenon called a short squeeze. In today's video, we will break down what a short squeeze is and how it works. Welcome to Leapfrog, a channel dedicated to making animated explainer videos simplifying crypto and decentralized finance. If you're new here, be sure to subscribe. A short squeeze is a phenomenon that takes place when a cryptocurrency or a stock has an unusual degree of short sellers holding positions in it, and the price jumps higher unexpectedly, causing a domino effect. This definition is a mouthful, so let's break it down for you. First, let's understand what it means to hold a short position. Shorting is a trading method that involves selling an asset now with the hope of buying it later at a lower price. Traders often short an asset when they expect its price to drop for a short period, or if they are bearish on the asset. The process of going short on an asset looks something like this. To begin, the trader borrows the asset in the market using a margin account. Immediately after borrowing, they sell it to a buyer who is willing to pay the market price for that asset. And then, the trader hopes that the asset price will go down before they have to return the borrowed shares, so that they can buy it at a lower price. If they're right, they buy the asset back on the open market to replace the borrowed assets and pocket the difference between the price at which they initiated the short and the price at which they bought the asset back, to close out the short position. However, if the price of the asset goes up from the original price, the trader loses money. Unlike a traditional long position, where the trader buys an asset and hopes for the price of the asset to increase, shorting an asset leaves the trader open to the possibility of unlimited losses. Still confused? Let's explain with an example. Say the price of Bitcoin is $22,000, and Alice expects that there will be a decline in its price due to some reason. To go short, she borrows one Bitcoin through a margin account and sells it immediately to Bob at the market price of $22,000. Sometime later, Bitcoin's price drops to $21,000. Now Alice buys one Bitcoin back from the open market at $21,000 and returns the borrowed assets in the margin account. If you think about it, by predicting the price decline of Bitcoin and shorting it, Alice essentially makes $1,000 in profit. She bought the asset at $21,000 and sold it at $22,000, without actually ever having owned the asset. That is the power of shorting. Easy peasy, right? Well, not really. What if Alice was wrong in her prediction, and instead of going down, the price of Bitcoin rose to $23,000? In that case, to close her short position and to cut her losses, Alice would have been forced to buy the asset at a higher price and incur a loss of $1,000. A price higher than $23,000 would have meant even higher losses for Alice. If a heavily shorted asset unexpectedly goes up in price, short sellers often rush to exit their positions. As they place huge buy orders to cut their losses, the coincidental exit of these short sellers pushes the prices even higher. The continued rapid rise in price then attracts new buyers to the asset, creating further upward pressure on the price. The combination of new buyers and panicked short sellers creates an upward price spiral called a short squeeze. For a short squeeze to happen, the underlying asset needs to have massive short positions. This is exactly what happened to Volkswagen in 2008. In October 2008, when the world was in the grip of the global financial crisis, short selling was rampant in the market. But on the 26th of October 2008, Porsche revealed that it had gained control of 74% of Volkswagen's voting shares by buying up almost all of the company's circulating stock. At the time of this announcement, almost 12.5% of Volkswagen's stock was on loan to short sellers. The disclosure unexpectedly pushed up the price of Volkswagen shares, leading to what came to be known as the Porsche-Volkswagen short squeeze. When the market opened the next day, the short sellers raced to exit their positions to minimize their losses by buying more stock and in turn inflating the share price even further. On the 27th of October, Volkswagen shares opened at €348 and closed at €517, a rise of almost 150%. A day later, on the 28th of October 2008, the stock peaked at €999 per share, making Volkswagen the most valuable company in the world for a day. For those who sold a short share on Friday, the losses were brutal. If they had borrowed €100 of stock, it would have cost them €450 to buy it back. During the pandemic, we saw the exact same thing happen with stocks like AMC and GameStop. While shorting can be a profitable strategy, especially in bear markets, it can also lead to large amounts of losses if a short squeeze happens. Make sure you understand the risks before investing in strategies like this. We hope you enjoyed watching this video as much as we enjoyed making it. Make sure to hit the like button and subscribe to the channel. We make these videos every week, and your support keeps us going.